I've invested in a fund and so I should exit out of the fund. Is that what you're saying?
Some of the stock returns, what you would have anticipated in 3 years time frame, it
A stock price can overvalued or undervalued. The same thing will not happen for a fund.
there was a time when IT sector was a leader. Then consumption became. Now recently we saw defense and railways becoming leaders for this bull run.
If you have a bad management, even if the company and product is good, it can go for a toss.
When I'm evaluating the companies, the most important part is promoter, promoter, promoter. So sectoral funds have a highest risk. Why they have the highest risk? Because
Hello and welcome to Ventura Spotlight. It is a pleasure to have with us today Mr. Charanjit Singh, a fund manager at DSP Mutual Fund. Charanjit has over 16 years of experience in investment management and he currently handles two major funds. One is DSP Tiger and DSP Business Cycle Fund with an AUM of around 6,000 crores. So let's get started. Hello Charanjit.
hello, thanks for having me on the show.
My first question to you, Charanjit, is that, for viewers, who are watching you for the very first time, can you tell us something about your journey and what inspired you to get into the fund management side of the business?
Post my MBA from IIT Madras, I wanted to, do more of the work in the intellectual space in terms of the research, financial research. So after that, I joined a couple of global research houses like HSBC, BNP Paribas, and as a sell-side analyst. So I used to cover these companies as an analyst in the capital goods, infrastructure space, power utilities. And that used to really amaze me in terms of how companies are, functioning, how companies are growing through their life cycle, managing different challenges. And from there, I continued to work in the different sell-side roles in various brokerage houses in the international as well as the domestic market. But at certain point of time, an analyst has to decide that he wants to move on from the sell side to buy side. So buy side is where the real actual decisions are being made, where you are actually deploying the money. Whereas on the sell side is you are recommending to the fund managers that this is a stock idea I like and maybe you should buy it. Then it's all the fund manager's discretion. So in 2018, I joined DSP Mutual Fund and I was given the responsibility to manage the DSP Tiger Fund, which was a flagship fund, one of the first infrastructure funds in the country. And that gave me pretty good responsibility to manage this AUM and grow it and also take the responsibility of managing the expectations of our investors. So then I could utilize all the insights which I had gained during my working as a sell-side analyst with various brokerage houses, covering these sectors, going through the ups and downs of the various stocks and sectors, and utilize that knowledge to effectively implement in the investment decision making. So I think it was more a transition from just writing reports to actually implementing that and deploying it on the money.
You mentioned that, you are an alumnus of IIT from engineering into financial engineering. I mean, so what actually was the ticker point in terms of, trying to get into the equity market, which is more to do with finance?
So I think equity markets continue to remain one of the very challenging areas and also exciting areas for everybody when they look at financial field where you want to build your career. It is always exciting to see how the stock markets are behaving, getting impacted by the international factors. When you look at my profile, while I've done engineering and finance, I have been able to utilize both the learnings in my investment research field, because investment as such is not only about financials, it's also about understanding businesses, it's also about how the changes in technology is happening. If you look at capital goods sector itself, power sector, all these are very highly specialized sectors where you need to understand the products, you need to understand the dynamics of the regulations and utilize your engineering knowledge to understand also how the changes in technology are happening. So a lot of those insights as an engineer which you build to understand the technology gets utilized to understand the businesses. And then on top of that, you use the financial engineering to understand, how the financials of the company are, the balance sheets and cash flow. And when you merge together, then you're able to get a pretty good combination of utilizing both the fields into the investment research.
So good. So it's more of financial engineering.
Definitely. Yeah.
How has your role as a fund manager evolved over the years in terms of how do you see evolution has happened in the fund management side of the business?
Yeah, so see, fund management business is ever evolving. There are a lot of challenges which keep coming on. But you have to also see the nature of the market. When we see the nature of the Indian market itself or even the global markets, There were earlier lesser number of players, even in the Indian context. When you see, there used to be earlier large domestic institutional investors or large foreign institutional investors. Then came the retail investors who started becoming big. High net worth individuals, they also started becoming big in players in the market. Now, when we see, we are also seeing participation from hedge funds, which are extremely large and creating a lot of volatility in the market. So, what is also happening is that the number of players in the market is increasing. Earlier, the market used to have a slower movement because the information used to be with limited players. Now, the information arbitrage is reducing day by day because information is freely available. All the con calls, all the meeting updates, everything is available on the media. When you see now YouTube channels, there are a lot of YouTube channels which have come up which are educating the investors about the stocks, about the sectors, and it's a great thing what's happening, the financial revolution, what we are seeing. So information is now no longer limited to certain, part of the industry. It is getting, democratized. It is getting, spread out among people, among investors. So that is also creating that the movements in the stock market will be much more faster. The movements which could have taken maybe 5 years now could happen in maybe in 2 or 3 years or even in 1 year time frame. Some of the stock returns, what you would have anticipated in 3 years time frame, it could come in 1 year itself. So that is what the access to information does. The movement gets faster. Number of players are more. Volatility is rising because everybody is watching quarterly numbers so closely, and with more information, you tend to do more and more trading. You tend to do more and more activity. Whereas if you look at investing, it is more about long-term investing, finding good companies and staying with them to take the benefit of compounding. But that is what is changing in the fund management industry. And that is where you need to have a very clear process and a framework to actually ride through these volatile times.
In fact, yeah, I think what you're saying is right in a way because I think last year, had it not been for the domestic institutions, we would have seen the market at a completely different level with the amount of money with the FIs actually have withdrawn. So I think, yeah, what you're saying is makes sense. And I think now the speed is of essence. And in fact, that's what we are also doing. We are also trying to educate investors through our channel in terms of, getting into the insights of what a fund manager is looking into. So I think that's a good insight. So how do you balance yourself between where you have a conviction, right, and sometimes you also have to be cautious because you are a fund manager, right, but you also know that something is a very convincing idea, but sometimes it may be a quite a risky bet. So how do you balance yourself between conviction and caution?
The first starting point for a fund manager is that we are managing hard earned money of the investors. So if you have that starting point, you will always be very cautious in the way you are taking your decision because it's our responsibility to deliver the return for our investors. The point is that in the market, you build your conviction by doing extensive research. So for that, I will go myself on the ground. If there's a company which has got a distribution network, talk to the dealer network, talk to their competitors, talk to their suppliers, and build that entire knowledge around that company to get that conviction. Then comes the valuation part. Whether it's too expensive, what is the price I need to pay for that? And I don't want to overpay for something because that is the clear recipe for not being able to generate the returns. So that is where a clear process or framework comes into picture that, okay, how do you evaluate the companies? How do you figure out that, okay, you build your conviction better to hold on to those companies even through the downturns, even through the times when those are companies going through maybe 2 or 3 quarters of weak period? Because if you have an understanding that, okay, that these companies can continue to grow, they have a very strong moat, they have a very strong, balance sheet and the culture which can help them drive all these things, then you are able to take a high conviction call. Then it comes to the second part, which is sizing. Because I may not be able to size it up immediately right now. Maybe the valuations are high. We want to wait out for the right price to come in. Plus, we'll also look at the liquidity parameters. That, okay, how liquid is that stock? Because if it's very illiquid, a lot of times what happens is that instead of becoming a shareholder, you become a promoter of that company. So we have to balance that. And we have to see that, okay, what's the kind of right sizing which I can do? How much time it takes for me to build that position and how much time it will take for me to liquidate that position. And whether I am increasing the portfolio risk by sizing that particular stock disproportionately in my portfolio. So all those factors will be actually defined into then the portfolio sizing of that particular stock, and that will also help us reduce the risk by taking care of our conviction levels.
So you would call yourself as that you are more risk off, or are you a risk on, as in terms of when you formulate your strategy to invest?
These risk off and risk on, these are all the parameters of the market. Fine. When there is excess liquidity, then definitely, everybody wants to invest. There's a gush of money which is coming in. But when the uncertainties rise, the money flow starts reducing. And that we have seen also recently. And the other important point is that what happens is when the returns start thinning down. What we have seen, everybody around here has seen only a very strong bull market. A lot of investors who have come after 21, 50% of the new demats have got opened up. If you look at large part of the money in the thematic funds has come in last financial year. Now those returns, when they start thinning down, that is where investor behavior start changing. So at any point of time, for me, it is not about risk on, risk off. It is about what is the intrinsic value of that particular stock, whether I'll be able to make money in this stock or not, or street has already, built in high growth assumptions and everything into the stock price along with high valuation, which is what I'm saying is a clear recipe that I'll not be able to make money. So at point of times when you are not able to find ideas, then you may sit on cash. Then you are waiting out that, okay, when the valuations become reasonable, then I'll start deploying my money. And that is where the risk on risk off happens in the portfolios. And then you start also rotating your money among different sectors where you start finding value. So sector rotation, stock rotations, coming up with higher cash levels and lower cash levels, these are all part of the portfolio management strategy. As market gets overheated, you start, booking profit. And I tell investors that it's very important to book profits. Take home the money which you have made. Otherwise, it's notional profit. And that is what was happening in September timeframe. If people would have booked profits, they would have taken home some of the profits while the stock prices were correcting post that. So that is how I'll try to manage it in terms of the portfolio.
You have raised a very important point, take home some of the profit. Now, but since let us say, I have invested money in a fund, right? Is that not the call of the fund manager, or would you be advising that, let's say if I have invested in a fund and so I should exit out of the fund? Is that what you're saying, or are you saying that more from a, let us say, a direct equity investor perspective, that because a stock price can get overvalued or undervalued, but the same thing will not happen for a fund. I mean, because that call we actually leave it to the fund manager. So how does one take that decision?
Yeah. So what you're saying is right. That is also, this comment is more towards the people or the investors who are doing direct stock investing. And what we saw is that as the market was going through a bull run phase, a lot of investors, they started, investing directly into individual stocks. And that's where it is a very important part of their investing journey that they have to book profit. Now, when we come into the fund management, like you're rightly saying, that it is the fund manager's job. You don't want to stop your compounding. You're continuing with your SIP. And fund manager is taking a call in terms of how he wants to manage the portfolio, because that is his job, to manage the portfolio. So that comment is more from a, your own individual investment style. But I think it is also coming from the fact that if you have invested a lot into sectoral funds, that is where the money came in. So sectoral funds have a highest risk. Why they have the highest risk? Because your money is getting put into only particular limited number of stock. And one of the very important thing you have to always remember is that none of the themes, none of the narratives, they continue for very long time. There's a time when one particular theme will end and new theme will come in. And you see the history, every bull run had new market leaders, new leaders. There was a time when IT sector was a leader. Then consumption became. Now recently we saw defense and railways becoming leaders for this bull run. So that is where this will happen. The leaders will change. That is where in the sectoral funds, if you have invested your money, you have to be careful. You have to be cautious, and if you have made returns, you need to book profit.
So in fact, again, it gives me a very good question out here, because last year we saw the maximum amount of money being collected in thematic funds.
Correct.
Right? And you are also running both two thematic funds, right? So how do you see yourself at at this stage? Because you are running actually in, as you mentioned, on the risk parameter, you are one more on the higher end of the.
Correct.
Obviously, DSP Tiger is a very old fund, but we have seen the infrastructure, what happened to infrastructure, I think around 12 years back, and then they were stagnant. So how do you see yourself running thematic funds?
There's a clear differentiation between a sectoral and thematic fund. Like I said, sectoral fund is focusing only particular number of stocks, a particular sector, whereas a thematic fund can have multiple sectors between that. So when I took over the DSP Tiger fund, the main thought process was, let us study all the thematic funds globally and see what has gone wrong and what has worked for them. So that was the main point where we saw that if you are over indexed to a particular sector, that could be one thing which could impact your returns if you have to from a longer term perspective. Because as those sectors get re-rated, there'll be a point of time they'll become too expensive. Incremental returns will start thinning down. Growth will start getting impacted, and that is where the returns starts deteriorating. Or there could be certain policy related issues. If you see the previous cycle for infrastructure, there was a time that everybody wanted to buy all road contractors, all the infrastructure companies, but those companies became over leveraged. They became over, they wanted to just grow aggressively. When that happens, then it is setting a lot of those companies for failure. And when the downturn came, they were not able to manage. Because downturn is not that you will not have a downturn. It's definitely going to happen. After 4 or 5 years of bull run, we have seen how things have slowed down. Maybe it's the domestic factors, maybe it's the external factors. It is bound to happen. So that is where when you're running a thematic fund, then you have to have within that also multiple sectors, which will give you the room to rotate the money among the sectors. If you are not able to do that, then you are going to have a tough time when the sectoral shifts start happening. So when I'm managing the DSP Tiger Fund, DSP Business Cycle Fund, so DSP Tiger Fund, we have tried to make it more diversified. What we don't invest in is in the business, which is like, lenders, banks. We don't invest in IT, pharma, consumption. But rest of all the other sectors are available to us to invest. And that is how we try to then manage the risk, having the sectoral exposure and manage that during as the transition is happening from one sector to the another sector.
One of the thing what we observe, is that the most important factor is that the management. I think the management is very important.
Yeah.
And with the recent episode, again, it's come to light that if you have you need to have a very good management, the trust, right? And if you have a bad management, even if the company and product is good, it can go for a toss. So what are the intangibles that one should look at, specifically when you are looking at the business, when you're evaluating the business? So what are the intangibles that you look for?
One of the most important thing when you look at DSP as a firm also, we are a firm which focuses a lot on ethics and corporate governance. That has to be the gold standard. Now, when I'm evaluating the companies, like you're rightly saying, the most important part is promoter, promoter, promoter. How is the management? How is the promoter looking at his business? What's the kind of focus the promoter has? Do they have multiple businesses or do they have a focus on this particular business? What has been their track record of running the businesses and even treating the minority shareholders? Because that's the one very important factor what we have seen, that how the promoters have treated minority shareholders. Another important aspect is that how much of the understanding of the business they have and what is the vision they have. See, good promoters will have a clear vision where they want to take the companies, how they want to grow the companies, and how profitably they want to grow the companies. So I think a lot of those parameters have to tick for us in terms of their historical track record, in terms of their background, in terms of understanding the business, running the businesses, treating the minority shareholders, treating employees. We also look at the attrition levels, how well the teams are there and how long they have been in the business. Strong teams who have been there in the business, they're able to take the businesses to the next level. So these are a lot of factors which we study very closely. We also take the feedback from the other promoters who have seen these promoters growing, their customers' feedback in terms of how they have seen this company operating in their environment. For consumer companies, we'll even look at the reviews of the products of the company and how the management have responded to that. So I think these are very important factors which are showing us the quality of the company. And if the quality of the promoter is good, I think even if it is a downturn, we want to stick with them. Because we know that whenever the upturn will come, these are the companies which will perform very well. They are the companies which will be able to survive and thrive. In the investing world, that is the most important factor. If you are able to survive through the downturns, whenever the next upturn will come, you will be able to make good amount of money. And these are the promoters who have gone through the tough times, but taken care of the investors, taken care of the employees, taken care of the customers, managed their businesses well, haven't taken any wrong decisions. I think all these things are very critical for us when we are choosing or identifying the promoters whom we want to invest with.
So one investment idea which looked good to you, and but it was a painful lesson for you, so something which actually went wrong for you.
Yeah.
Can you share that?
I'll not name the company, but what I'll do is I'll just give a construct in terms of what happens. So there are companies which are promoter run and there are sometimes companies which are professional run, right? And what we have to also see is that what is the alignment of interest for the management. if there is alignment of interest, is in terms of the KPIs. What is the key performance indicators? Whether it is a market share or it is profitability. So a lot of times what we do is we are just focusing on the functioning, but we are not seeing that, okay, what is the key performance indicator? Now, some of these companies, when they go through rough time, the managements will try to focus on the key performance indicator, what is driving their bonuses, right? And it could be the profitability over market share. But what we have seen is that if you lose market share, it's very tough to regain that. And that is what we saw that in one of the company, it was a global MNC, and there was a lot of focus on the profitability at every point of times. But when the competition increased, they continued to focus on that and increase their prices. And that led to a significant collapse in the market share. And that led to the impact on the stock price. So I think that is where you have to be very careful in terms of what is the focus for the management, and then you see the outcome.
One which actually even tested your patience, but also made good amount of money for you in the fund.
Yeah. So, see, the point is that why we talk about long-term investing, because the point is that even managements don't know that when the things will start picking up. And a lot of these businesses are cyclical. They may be lumpy businesses, right? Now, even if you look at defense sector, for example, defense companies used to be trading at 12, 15 times P multiple. Nobody used to care about the defense companies and we used to hold them. But the point is that you are holding them because they have a capability, and you know that whenever this capability, gets its right share, the re-rating will happen. So that's what happened in the defense space. So we were holding some of the large defense deep PSU firms, and when we identified those and built large positions, they were trading at very cheap valuations. But there was a very big change which was happening, which was that government policy was becoming much more favorable to the domestic companies. And as that change happened, the re-rating started happening in the defense space very significantly. So I think that is where the patience, identifying right companies and who have the right kind of product which is approved by the defense forces. Once you have that, then you have a clear recipe for getting a winner.
I think, yeah, defense, most of the defense stocks give a good return. Maybe some of the late entrants were not able to make much of it. So one more thing, what happens is that, we always, we keep on talking about investing for the long run. We talk about power of compounding, that, how your money multiplies. I think there are enough narrative is out on that. But unfortunately, what we actually land up seeing as a result in, I think in most of the funds or wherever you take it, right? So there is a reality that a fund, the NAV of some of the funds have given fantastic returns over 15 years and 20 years, compounding at 18% CAGR. But when we actually go and see, uh, the investor experience is completely different. So what would be your thought, in terms of that? What do you think that, why is the investor behavior to that extent? What makes them behave? Why do they get out? What is your thoughts on that?
What's happening is that when you look at investors, and rightfully so, everybody is chasing returns. And when you see most of the money which any fund manager gets, they get that money after their return performance has been pretty strong. And this is a given fact that if your performance has been very strong for last 3-4 years, you will go through a rough patch of maybe weak performance, because the stocks will also take a pause. The businesses which are holding, they'll also take a pause. There'll be a shift in the sectoral allocations which you are holding. So that is bound to happen. That is where the investors lose interest, because they have come up looking at the high returns and they're losing, or they're moving out when they start seeing the returns getting shrinking. Now, what happens is generally that when investors are continuously looking at their portfolios, when a lot of information is getting bombarded at them, that is where this kind of decision changes. Now, when you look at right now also, if the SIP cancellations are happening, it is happening in the direct world, not in the advisor route. Because investors who are directly coming, they are not able to see that, okay, they have to stay here for longer term. But advisor is able to guide them and tell them that, okay, what is the power of compounding and how you should stay in the funds. So I think that is where the investor nature will improve. It will get better as more and more financialization is happening in India. Mutual fund product is becoming more and more available to the investors. And I think this behavior is going to get better. But it is more about how strong we are emotionally to sit through weak period of returns and wait for those good returns to come back, and how we are trying to also align them in our goals. That's what we tell investors, that you have to do the investment based on our goals. It is not for next 1 or 2 years or 5 years. It is for your longer term. Maybe it is for your retirement. Maybe it's for kids' education. So that is how once you align your goals, then you are on the right path. Then you're able to hold those investments even through the rough times, because you know that everything will go through the cycles.
My thought was as one is that we keep on talking in terms of percentages.
Yeah.
But I like the way insurance industry does. Like they talk about, you put 2 lakhs, after 20 years you'll get 20 lakhs. Okay, because they cannot talk about the percentage, because it will be 6% and 7%, right? What I find that since we talk about 15% compounding and 12%, but we never say the amount. Like if I tell we have that calculator that 15,000 for 15 years, at 15% will give you a crore, right? Why should we say 15%? And you can target around a crore. So I think that if to a certain extent we also need to change the narrative, right? And it's good to hear that the SIP stoppage is more on the direct side, so there is something good for us in that sense. So how like in fact one more, I'll just take a counter on that, is that what we are seeing is that investors chasing returns, and we saw it happen in small cap funds, and then the regulator also had to step in and by saying that there is a lot of money coming in because of returns. We saw it in the defense as a sectoral fund, and everybody is going chasing the sector, right? Now how should investors then change their behavior, because unfortunately that is what they see, and that is what they carry it forward, that the same return, that if I am got 40% in year one. So what's your thought on we also have something as a principle of reversion to the mean.
Correct.
Right? So how does one explain that phenomena to the investors? So maybe you can share your thoughts on that.
When I tell investors, they need to have a portfolio approach. So as a 100 rupees what you're investing, how you are investing that, and you need to have products or the funds in your portfolio which are also diversified. There's a core portfolio, there's a satellite portfolio which you have. Satellite can have some of the maybe sectoral or thematic funds where you have a limited exposure, maybe 10 to 15% of your portfolio to benefit from the themes which are coming up, and remaining 85% going into more diversified strategies. So that is how I tell investors that you build your portfolio and then you align it with your goals. And if you keep on tinkering that today I want to get out of this fund and jump into another fund, that's going to just impact your compounding. And once you are put into a good diversified fund and have allocation to flexi cap, a mid and a small cap, so you are taken care of your investment requirement. You have taken care of how your goals you are going to achieve. Maybe you can also have an exposure to certain metals, the precious metal where we are seeing as an asset class, we should definitely have an exposure. And now industry has also brought in good funds like multi-asset fund, which is also giving you that option of having that asset class. So I think as a mutual fund industry has now progressed well in terms of bringing in these kind of products for the investors. And that is how you need to align. And once you built your portfolio, you have to just continue with that compounding. And mean reversion is definitely going to happen because the returns which are there, they are being either driven by the illiquidity, stocks are illiquid, they are just rising, or investors who are chasing themes. And that is what we saw, that everybody was chasing themes every day. There was railways theme, there was defense theme, then there was capital markets theme, then there was renewable energy theme. So all these are themes which may not last for very long. And there's a lot of upfronting of returns happens. Next 5-year, 10-year return already has been upfronted and has been built into the stock price. So definitely you are going to see your returns thinning down. So that is where investors have to be educated that a consistent return of 12% is pretty good enough. And that's what we need to aim to beat the fixed deposits.
There is also always an expectation you should outperform the benchmark. It's very easier said than done.
Yeah.
In fact, today I had a very interesting conversation with one of the journalists that now in 1 month, the number of active funds performance has actually gone down. Right? And in fact, it set me thinking. I said that, you also need to look at that. Let us say now I have invested. I've invested my money and it gave me a return. Let us say it was in 23-24 when small caps was doing very well.
Yeah.
I got a return of around maybe 40-45%. The benchmark was 60%.
Yeah.
So should I be happy or should I be sad? Right? There is a person who invested in large cap. His investment return was 25%, and the benchmark gave a return of 23%. Right? So he outperformed the benchmark. The small cap guy should be sad and large cap guy should be happy, or it should be vice versa. So this question keeps on coming, and I'm sure there is always a little bit of pressure also on most of the fund managers, because that's where you try to target yourself to outperform the benchmark. So how do you handle that part of the situation?
Benchmarks are the place where we are getting judged in terms of our performance versus the benchmark. How much extra return you are able to generate versus the benchmark, that's the alpha, and that is what a fund manager is aiming to. And how that is going to come through, that's going to come through your stock selection and sizing. Now there could be times, like you rightly said, active fund manager may underperform because some of the stocks, based on the fundamental research, based on the conviction level what they have picked up, they may not move immediately. They may move, in step function. Maybe, they are moving right now, then they kind of slow down, then again they move, and then again slow down. So that is where having a clear framework of investing and investment process comes into picture, that even if during certain times when you are underperforming, you are sure that why you are holding those stocks. And underperformance could also come because of the fact that certain stocks which have got added into the index, they are, just being done running up on the narratives. And when that reverses, the downfall will also be severe. So that is what is getting tested through your investment philosophy, through your process, and through your frameworks. That in the tough times of when the market is outperforming your fund, you are able to hold on. You are being disciplined that I will not deviate right now from this approach because this thing is happening which is irrational, and irrationality will happen in the market. But there is a time when it will reverse, when the returns of those stocks will start coming down, money flow will start reversing from those funds, then you will see that the things will come back onto the ground, and your philosophy or your investment framework is only what is going to help you. And that's where the fund managers are being looked at 1 year, 3-year rolling returns rather than looking at a more short term. That's where longer term makes more sense, because that is how the companies also work. Maybe companies will not see the performance for maybe 1 year, 2 years. Sometimes we are seeing like 5 years, there has not been any growth. But then suddenly there's a spurt in growth which comes in. And that makes up for a lot of the time what you have not been able to generate the return, but the stock gives phenomenal returns.
So would it be fair to say that, like, supposing if I want to judge a fund manager's performance, I should actually look at a 3-year rolling return?
Yeah.
And
so
whether it outperforms a benchmark against that?
Yeah, that's true. So it makes sense to look at a longer time frame. It's also very important to look at the investment philosophy of the fund manager, how the track record has been, how the communication with the investors have been. I think a lot of those parameters are very critical when you're evaluating that, okay, what fund manager, which scheme you want to buy, and then, add into those, units.
So one investing principle that has, served you well through both, the bull market, the bear phase, or even a phase where, nothing is happening in the market.
Yeah. So I think the most important principle is definitely stick to your framework of investing. What is the intrinsic value of the business and why you are holding that business? What is the runway of the journey for where this company is right now, what it can become? Because see, ultimately we are buying businesses. And if you don't have a clear path to that, what runway is there for that business, then you will not be able to hold it. Maybe the stock doubles and you are keen to sell that. But the journey of 10x or 15x, that only happens when you are clear that, okay, that this journey is pretty long. So that's most important principle what I see.
We have spoken a lot about managing money, right? So how do you switch off and recharge yourself? So, I'm going a bit off topic in terms of.
So I think that's very important thing, because stock market is such that every time the things keep on happening. In the evening, you will be talking about more international markets. During the daytime is the domestic market. So it's very important to switch off and take your time off, spend time with the family. I have 2 kids, play with them, take my son for football, take my daughter for her competitions. So I think that's what gives me the great pleasure. I think that's the best thing what we can do.
Any sport you play?
So I just do a little bit of running and I play football with my son.
Great. I just wanted to do a bit of a rapid fire with you. So the first stock you ever bought?
So it was a German multinational company, engineering company. It was a very interesting story because the entire street was pretty negative on that. And we saw that there were a lot of changes which are happening. Digitalization, automation, these were the things which are becoming very big things. and people are ignoring that. So the most amount of money which has been made is in the stocks which are getting ignored.
Oh, that's an interesting thing.
Yeah.
So most overused investing buzzword today.
So I think the most overused buzzword is like structural. When people say that, okay, this structural, this will continue for decades, my whole advice is that nobody's sure about decades. You have to consistently evaluate. Themes will keep on changing. New themes will come. Sector rotations are bound to happen. Nobody can stop that.
Okay.
And when you look at the even sectoral rotation quilt, you will clearly see for 2 years, one sector performs extremely well, then the returns go down.
Correct.
Money will definitely rotate across sectors.
So if not finance, then what?
I would have loved to do consulting. I love knowledge related work with companies closely. I think that's one area which I would love to do.
Read a book or binge on a series?
Read a book, definitely. Books give us good learnings from what people have learned from their own mistakes, diverse things you can read through. So I think definitely reading a book is a great pastime.
So would you prefer vada pav or chole bhatura?
Yeah, so I always say that when you are in Rome, be like Romans, okay? So when I'm in Mumbai, it's vada pav for me. When I go to Delhi, it's definitely chole bhatura. Nobody can beat that.
One Indian brand on which you would bet for the next 10 years?
Definitely, I think Tata's is a great group, and the brands what they're creating, they're doing an amazing job. And I think it's a good company, again, coming from the fact, great corporate governance, great leadership. That's what they fit in.
One question, if you get an opportunity to ask Warren Buffett.
Yeah, that's interesting one. So the point is that people talk about the competitive edge, the advantages. These things are changing rapidly in this world. There was a time that you used to see technology changes happening in like 15 years, then became 10 years, 5 years. Now it's happening in 1 year. So these are changes which are disrupting businesses very fast. How do you live with these disruptions and manage the investment in this phase of disruption?
In fact, there was the Sanjeev Sanyal, who's economic advisor to the PMO.
PMO.
In fact, he's talking of that we are going to be in the age of creative destruction.
That's
yeah. One financial myth you wish people would stop believing.
People are chasing returns. That is definitely a financial myth. That if the returns have been pretty strong, or if this stock has done very well, it will continue to do well. That's the biggest financial. Because then they are taking higher risk. And it is not always that because you are taking a higher risk, you're going to get rewarded. And a lot of times, especially for retail investors who are coming into the stocks at very high valuations, their money is going to get stuck for a very long time.
And finally, coffee or chai?
Chai, definitely.
So thanks, Charanjit.
Thanks for the opportunity.
Pleasure having you here. So thank you very much.
Thank you very much.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully before investing.